Hello, everyone, and welcome to this edition of Individual Stock Picks. Today, we are going to be talking about a new company. But before we get into it, let's first rehash the valuation of stocks. Stock's current price reflects all available knowledge of prices in the future. The price is a function of future earnings and cash flow, coupled with current income, which are dividends, and a multiple being paid, which is the valuation. Fundamentals change over time. Most stock movements in the short term reflect a change in multiple based on sentiment, positioning, events, and or news. Valuation in the long run, I think 5 to 10 years, is the biggest driver of excess returns. So today we are going to talk about Pfizer. Pfizer is one of the largest pharmaceutical companies founded in 1849, 35 different manufacturing facilities across the globe. The biggest driver or benefit is when they have a new blockbuster drug, think Viagra or the COVID-19 vaccine. They can generate a lot of money in a very, very short period of time when they have one of these blockbuster drugs. Now, the risk to that is when these drugs come off patent. So you always need to have future growth or future blockbuster drugs that come in. As well, they also have large sales forces and expenditures, and they also have large R&D expenses. So they do have to spend quite a bit of money to keep up to that future growth. And lastly, an aging population and a person's health not being discretionary are actually very, very strong long-term trends. Our population is not getting any younger. We're not getting any healthier. So we are going to need more and more drugs to take care of our population. So first, let's talk about Pfizer's stock price. Now here we just have a chart from 2019 to today. Even though Pfizer sold billions of dollars worth of the COVID vaccine, stock price is actually down pretty dramatically from when they announced the discovery. So here's the announcement in November of 2020. 3 years later, the stock is down almost 24%, or about 8.5% per year. Not something you would have guessed at the time when they basically got everybody back out in the world and reopened the economy when they did that COVID vaccine. So let's talk about the financials. I'm not going to go through every single number here, but one of the things you can see obviously is their revenue numbers about 40 billion, 42 billion. And then after the COVID vaccine, it jumped to 81 billion in 21, 100 billion in 22, and then it's actually going to drop back down to around 59 billion in 2023. So again, still higher here than where it was pre-vaccine, but these huge numbers, you're talking about 40, 60, almost $100 billion worth of revenue that was in 2 years that was attributed solely to the COVID vaccine. And so as we have natural immunity, people aren't taking it as much. Obviously, these numbers are going to come down. However, that windfall profit is still there. And so as you can see, obviously as well, your cash flow numbers, free cash flow, that they're available to do, either buy companies or increase the dividend. We've got, pre-vaccine, 10 billion, 12 billion. During the years of the vaccine, 29, almost 30 billion, 26 billion. So pretty significant increase in cash flow. Now we're going to drop back down for this year and next year, similar to where we were pre-vaccine. But it's just interesting to note, obviously, again, these were outsized profits and they were still real, but it's not something that you can count on going forward. And so you want to kind of normalize the stock. I don't know if it necessarily means the stock should be down 23% from where they were before they made this $100 billion, but it does give you a general view of what to expect. And one of the things you can see too is, not only is the revenue numbers, but the earnings per share, you could see is dropping down for this year, pretty close to where it was before. And then actually next year is expected to go up pretty dramatically once again and be similar to where it was between actually much higher than where it was pre-COVID. So again, now we're going to take a look at the Pfizer dividend, because this is something that we find important in the current environment. So one of the things that's interesting is even with their windfall profits, you can see here in the orange is the increase in the dividend. So it's been pretty steady over the last decade. 2 to 3% a year, basically an increase above inflation in that dividend. Now, you got $100 billion worth of profit. You would think that they could simply go ahead and do a one-time dividend, return that money to shareholders, but that's not what the case was. Now, currently, where the current share price is, that's still 5.4%. This is higher than what you're going to get in any particular bond across the entire yield curve. So it's still fairly attractive at 5.4%. And actually, one of the highest, this white line, is the dividend yields, which is actually at the highest at 5.4%, even than where it was pre-COVID. And that's just a function. The yield is a function of the amount of dividends paid, also by the price. So you can see that shares, without looking at the stock price being down 24% since they announced in 2020, you can still see, just based on the dividend, these shares are very, very cheap currently. So now we're going to talk about Pfizer's growth strategy, because it's not just about what you do for me now, but what you're going to do for me in the future. So one of the things that's been interesting is, as opposed to, again, like we said in the last slide, increasing the dividend or paying out that massive windfall back to shareholders, they use that money, $65 billion worth, on acquisitions in order to boost future growth. So I'm not going to go through every single one of these, but there's some fairly significant ones. So you can see these 25 million, these smaller ones, they were actually, that's not a full acquisition, it's a minority stake. And you can see these are, clinical revenue generating, clinical revenue generating. These are the different stages that they're in. This is the type of purchase. So every purchase was actually a cash purchase. And you can look as well, you can see where they're looking for future growth. A lot of that is in cancer. So cancer, immunotherapy, which is, again, think COVID vaccine. Cancer, they're looking at digital medicine as well. You actually see that here with digital medicine. And then there's one here with the phone app. You've got sickle cell disease. You've got NASH, you've got CAR T, cancer, and actually drug-resistant antibiotics. So, and then here as well, gene therapy, and also cancer for this particular acquisition. So they spent a lot of money that they purchased on several different companies. Now, as anybody that's invested in healthcare in the past knows, it's not as if every single one of these are going to pay off. Okay. In fact, they're 1, 2, 3, 4, 5, 6, 7. There's 22 different purchases. And of them, 1, 2, 3, almost half of them are actually already generating revenue. So that should help out the company in the short term. And then you have another half that are potentials for future drugs. And so if only 1 or 2 of those hit and create the next blockbuster drug, you're talking about spending $25 million on something that could potentially be a multi-billion-dollar drug. And so it's something that you would expect that not every single one of these is going to fail. Some of them are going to hit, and that's going to be a huge, or allow for huge future growth for Pfizer, and those earnings to get boosted higher. So where can Pfizer prices go? And in our view, 2023 should be the trough for earnings as the COVID vaccine uptake stabilizes. So we had a burst of COVID vaccines. Now we've got people that are not taking it as much, and you're still going to have a few that take it. So we expect that to stabilize probably this year. If you're going to take the vaccine, you're going to take it. If you're not, you're not. And that's kind of what's going to be that landscape moving forward. Additionally, there's a lot of acquisitions, as we just went through over the last couple of years. As those are integrated into Pfizer, that's going to add to earnings in the future. So that's why we expect 2023 to be the bottom of earnings. Additionally, cash flow should start to begin to increase again in 2024, which will give stability to the company, along with some potential upside from the recent acquisitions. Now, the interesting thing, and I think this is very, very important, because they did so many acquisitions, a lot of times the companies don't have the cash flow to be able to do that. And so because of their windfall, the long-term debt on Pfizer is actually lower now than it was in 2019 before the COVID pandemic. So that entire buying spree was self-funded, which makes that less risky, especially at a time when interest rates are much higher than where they were 3 or 4 years ago. So this increase in interest rates is not a hindrance to Pfizer, and the fact that they can wait for a lot of these companies to eventually go through their FDA approvals and get some of these drugs on the market. So even without that, a market multiple on this stock, without any new drug breakthroughs, we think the stock should trade near 45 and almost 50% higher than where it currently is. And that's along with the 5.4% dividend. Now, if one of those companies that they purchased creates a breakthrough drug, we could see the stock price approach $60 or more. So for us at $30 a share, we think that this is a good risk reward. We think that there's stability under the stock. There's a very reasonable dividend, and there's a lot of potential future growth from all the acquisitions.